Inflation is proving extremely sticky, which begs the question, how high will the Fed have to raise interest rates in order to finally get control over inflation? Based on two recent findings, it looks like interest rates may have to get a lot higher than previously expected by both the Fed and most market participants. First, we have the latest minutes from the Federal Reserve's last meeting that show they may have to raise rates much higher. And number two, we have a recent paper released by the Federal Reserve Bank of Cleveland that suggests that may be accompanied by a deep recession as well. So let's break this down. What has been happening recently that is making the Fed rethink how high they might have to go with interest rates? Well, number one, we just got the recent personal consumption expenditures release, and that showed a reacceleration in inflation. So we saw an uptick here instead of the continuing downtrend. We also saw a large increase in the change in inflation adjusted spending, which is a month-over-month figure. Now, at their last meeting, they only raised rates by 1/4%, and this was the smallest amount that they had raised rates by in the last year. They've been doing 0.75% at a time and 0.5% at a time. So they've been slowing down the pace at which they are increasing rates. But the minutes from their latest meeting showed that some participants still favored a 0.5% increase because this would more quickly bring the target range to the levels they believed would achieve a sufficiently restrictive stance. Basically, they were saying inflation is sticky and we need to get to higher interest rates, so might as well get there faster rather than drawing and dragging this out as long as possible. Now, James Bullard on CNBC on Wednesday said that he thought 5.375% was probably around where they would need to be, which is a lot lower than what newer estimates have been showing. A new study showed that the Fed may actually need to get all the way up to 6.5% in order to stop inflation. This was a 55-page academic study that included some simulations to try and predict what the Fed might do with policy rates, and these models suggested that rates would peak at 5.5 to 6 or maybe even 6.5% during the second half of this year. Now, given the fact that higher interest rates are already causing a massive increase in expenses and deficits for the United States government, a huge slowdown in the real estate market, meaning that people can't afford to sell their house because they can't afford to buy that next house, there's no transactions happening there. We're seeing an increase in borrowing costs for households as credit card rates go through the roof. So we're seeing a lot of things that could spell economic pain for the average American consumer, which is why in this paper they said that this casts doubt on the ability of the Fed to engineer a soft landing without a mild recession. Yep, you could say that. In fact, the Federal Reserve Bank of Cleveland themselves actually said that this probably would not be likely, that a deep recession would be necessary to achieve the projected inflation path, which is inflation coming down to 2.75% by the end of 2025. Putting these all together mean that both the market and even popular figures like Jamie Dimon said that rates are probably going to hit 6%. And Cleveland Fed President Mester, Fed Governor Jefferson said that they think inflation could persist longer than they originally thought. All this added up together means that inflation is probably sticking around longer than everyone expected, and that interest rates will have to go higher than expected to deal with it. And since that's the consensus, you know that that is just not my opinion. It's difficult not to be a contrarian just for contrarian's sake, but we have to look at the mechanics here of what drives inflation. And it is always the supply of money versus the supply of everything else. We know that the only thing the Federal Reserve cares about is year-over-year inflation. They don't care if your eggs, your gas, your house, your car ever gets back down to the price that it was before 2020 started. They just want to make sure that prices stop going up from here, that we'll reach a new plateau of prices. Maybe they only increase by a little bit. We also know that most of the price gains as a result of all of the money printing happen within 12 to 18 months after the money printing. Asset prices respond basically immediately to monetary policy, but it takes about a year to a year and a half for that monetary policy to work its way throughout the economy. And for over a year year now, money supply growth has been negative, meaning there is more money in the system last year at this time than there is now. And given the fact that they are always looking at extremely lagging data, they are backwards looking, and they look at this data and they're always wrong. They thought inflation would be not existent. And then once it showed up, they thought it would be transitory. And then once they realized it wasn't transitory, they thought it would be mild. And then once it was persistent and extreme, then they started slowly raising interest rates. And now, a year and a half later, they're finally at the point where they're saying inflation is sticking around forever and we're gonna have to raise rates even higher. It's probably almost done. I've been saying for a long time that Q1 of this year, so probably by the end of March, we will see inflation numbers come crashing down. I could be very wrong about that still, but I still think that's gonna hold true because of the way inflation works. It's the money supply versus everything else. Obviously, if the total supply of everything else just collapses, then it doesn't matter if the money supply doesn't change, that will drive prices up. But we're not seeing that happen, at least not yet. Now, I understand that the government is running massive deficits and those deficits are increasing. And I understand that there are arguments saying that government deficits are going to result in continued persistent and higher inflation. And I'm going to be putting together a video on those arguments because I want to make sure that I'm not just looking at this from one angle, because there's no point to continually being wrong. Might as well see if I might be wrong about that and be able to change my mind. But as of yet, I'm still not convinced that the mechanisms involved in the deficits, while they're not being monetized by new money printing, could result in inflation. I'll make a whole nother video about that, though, at a later point. As always, really appreciate you guys. Thanks so much for watching. Have a great day.